Canadian Apartment Properties Real Estate Investment Trust, ticker CARUN, posted a slight top-line and bottom-line miss for Q2 2026. Revenue came in at $246.41 million, missing the primary Wall Street consensus of $248.80 million by 0.96%.
Right, though it did barely edge past the LSUG mean estimate of $245 million.
Yeah, barely. And on the bottom line, diluted funds from operations, or FFO, hit C.65 last war per unit. That missed the C$66 estimate by 0.91%. But here is the headline that's really turning heads.
Oh, yeah, the big one.
Right. On an IFRS basis, the trust swung to a massive net loss of C$63.97 million compared to a C$74.48 million profit just a year ago.
Which is just a brutal swing.
It really is. And to add to that, management revised their full-year guidance downward. They're now projecting revenue growth to be flat to slightly positive at roughly 1%. Which is down from their previous 1% to 2% target.
And, the market reacted with understandable caution.
Yeah, shares traded flat in the immediate after hours and then dropped 1.25% in the next full session, closing at C$33.88. So the stock is sitting just 2.2% above its 52-week low.
I mean, those are incredibly heavy numbers for retail investors to digest right out of the gate. They paint a picture of a real estate operation facing some very immediate friction.
They do. Because imagine reporting that your apartment buildings are practically full, you are actively charging higher rents, and your operating margins are sitting at a pristine 66%, but you still have to tell Wall Street you just lost nearly $64 million.
It sounds completely contradictory.
Exactly. So today, we are doing a deep dive into CAPREIT's Q2 earnings report, alongside a stack of fresh analyst notes, to figure out how Canada's largest publicly traded rental housing provider managed to do exactly that.
We're going to look at the underlying segment performance, analyze the new CEO's commentary on this so-called turnover trap.
Right, and we'll explore the notable risks driving this massive divergence between the trust's actual real estate value and how the public market is currently pricing it.
Sounds like a plan.
Okay, so let's unpack this net loss first.
Yeah.
I mean, a nearly $64 million net loss screams mass exodus to me.
Yeah, for sure.
It sounds like the buildings are emptying out, tenants are fleeing, and the underlying business model is just fundamentally broken. But I'm looking at the physical metrics in this earnings report, and they don't match that headline narrative at all. Walk me through the actual operational data.
Well, what's fascinating here is the sheer disconnect between the accounting reality printed on the income statement and the physical reality of the properties.
Right.
I mean, if you walk into one of these CAPREIT buildings, the physical metrics tell a story of incredible operational resilience. Canadian same property physical occupancy remains incredibly tight. They are sitting at 97.5% occupancy for the quarter.
Wow. Which is effectively maximum capacity. I mean, you always have some natural friction of people moving in and out, units being painted or cleaned, so 97.5% means the no vacancy sign is lit.
Exactly. And they aren't just keeping the buildings full, they're extracting more yield from the units they actually have.
Okay, how so?
Well, occupied average monthly rent, or AR, is up 2.3% year over year, reaching $1,738.
That's solid.
Yeah, and if we look at same property net operating income, which, isolates the actual cash generated by the properties they've held for more than a year, that NOI grew 0.9%. But more importantly, the NOI margin held incredibly strong at 66.2% for the quarter.
Okay, let me try to frame this with an analogy for the listener, because the math is wild. It's like looking at a restaurant that is completely fully booked every single night. The tables are packed, the menu prices actually went up 2.3% from last year, and they are keeping 66 cents of profit on every dollar of food they sell, well, before paying the bank.
That's a great way to think about it.
Right. But the building they operate in was just reappraised at a significantly lower value because commercial mortgage rates went up. So the restaurant's corporate parent claims a massive overall loss for the quarter. The food business is booming, but the real estate math is bleeding.
That restaurant analogy perfectly captures the dynamic. The accounting loss comes entirely from the building itself, not from the daily operations of serving the tenants.
Right, the rent is still coming in.
Exactly. The loss stems primarily from a non-cash $123.66 million fair value write-down on their investment properties.
But how does a paper loss of that magnitude actually happen when the buildings are generating more cash than before? We need to break down the mechanism of that write-down.
Sure. So think about the mechanics of capitalization rates, or cap rates, which basically dictate commercial real estate valuations. Under the International Financial Reporting Standards, or IFRS, real estate companies have to regularly revalue their properties based on current market conditions.
And right now, conditions are rough.
Right. We are operating in an environment of elevated interest rates. When interest rates stay high across the broader economy, the risk-free rate of return rises. So investors suddenly demand a higher yield to take on the risk of owning physical property. As a result, capitalization rates go up.
Because capital is fundamentally more expensive. I mean, if it costs a private buyer 6% to borrow money from a bank, they aren't going to buy an apartment building that only yields a 4% return. The price of the building itself has to come down to make the math work for the buyer.
You nailed it. That is the mathematical gravity of real estate. Even if the net operating income, the rent collected minus operating expenses stays exactly the same, a higher cap rate shrinks the total valuation.
That makes sense.
So that $123.66 million loss is simply the accountants adjusting the assumed value of the portfolio downward to reflect this higher interest rate reality. The buildings didn't vanish and the tenants are still paying rent.
Right.
But when you couple that massive non-cash write-down with genuinely higher mortgage interest expenses on their variable debt, plus the lost net operating income from properties they actively sold off recently, you get that nasty headline loss.
Which means the core operations are actually highly profitable. But, that logic leads us directly into a glaring contradiction in this report. Yeah, I mean, if the core portfolio is 97.5% full, and generating a 66.2% margin, why did management just lower their forward revenue guidance? They cut their target down to roughly 1% growth. If you have full buildings in the middle of a national housing shortage, shouldn't top-line revenue be climbing much faster just to keep pace with inflation?
Well, this is where we get into the turnover trap. If that trap means you can't grow revenue by raising rents, you really have to look closely at the lease transition data. CFO Stephen Coe provided some crucial commentary regarding short tenure lease transitions.
Okay, what did he say?
Usually when a tenant moves out, a landlord expects to raise the rent to current market rates. That's a positive leasing spread. But for CAPREIT in Q2, the blended rent change on suite turnovers actually dropped to a negative 1.2%.
Wait, hold on. I have to push back on that.
I know, it sounds crazy.
It goes against everything you read in the financial press right now. The broader macro narrative is that Canadian rents are sky high, there is a massive structural housing shortage, and affordability is at crisis levels. How does the largest corporate landlord in the country actively lose money when a tenant moves out and a new one moves in?
I totally get it. It sounds completely counterintuitive on the surface. But if we connect this to the bigger picture, it makes perfect sense. You have to look specifically at who is actually moving out.
Okay, who is moving out?
The negative spread is being driven heavily by what management calls the short tenure cohort. These are tenants who signed leases less than 2 years ago, meaning they secured their apartments during the absolute peak of the rental market frenzy in 2023 or early 2024.
I see. So they locked in at top dollar when bidding wars were happening for standard one-bedroom apartments.
Exactly. And market rents in certain localized areas have actually cooled slightly from those absolute dizzying peaks. So when a tenant who signed a peak price lease a year ago moves out today, the new market rate the trust can charge is actually a bit lower than what that outgoing tenant was paying.
Wow, so they're replacing a high-paying tenant with a slightly lower-paying one.
Right. According to the earnings call data, that short tenure cohort makes up about 28% of total leases, but represents roughly 45% of the current turnover volume, and they are turning over at an average loss to lease of 10.8%.
The ecology there makes total sense. I mean, the people who have lived in these buildings for 5 or 10 years, paying heavily rent-controlled or below-market rent, they aren't the ones moving.
No way. They are staying put because it's cheap.
Right. The people moving are the ones who just got there, realize they are paying absolute peak prices, and are either leaving for cheaper localized markets or negotiating lower rents elsewhere.
Spot on. And management noted it is going to take 18 to 20 months to completely flush this negative short tenure cohort through the system.
That's a long wait.
It is. And to make matters even more complicated, just to get new tenants into these vacated units in a slightly cooling market, competition has required CAPREIT to drastically increase their leasing incentives. They handed out $4.6 million in promotional incentives in Q2.
Wow.
Yeah, which is almost double the $2.6 million they offered a year prior.
That is a massive jump in promotional spending. I mean, offering 1 month of free rent, free parking, or waived fees just to maintain that 97.5% occupancy rate.
Yeah.
But is this a national problem for them, or is this pain isolated to specific cities?
It is highly localized. Management specifically called out cooling in major markets like Vancouver, Calgary, and Montreal.
Okay, that makes sense.
Yeah, Vancouver is seeing a lot of new condo supply hitting the rental market simultaneously, and Calgary and Halifax are also facing significant new apartment deliveries. This sudden influx of supply gives renters a lot more leverage and options, which forces the trust to accept lower leasing spreads and offer those heavy cash incentives.
So we're looking at sluggish, roughly 1% organic top-line growth until at least early 2027 while this short tenure group washes out.
Yeah.
I mean, if you can't grow revenue organically by jacking up rents for the next 2 years, you have to engineer value somewhere else.
Exactly.
So how is the new CEO, Brad Cutsey, planning to generate returns without that organic growth?
Cutsy's strategy right now is entirely focused on aggressive capital recycling. They are systematically selling off assets and redeploying that capital where the math makes more immediate sense.
Okay, give me some examples.
Well, in Q2, they closed a $98.7 million privatization of European Residential REIT, or BERS. They also sold off $72.5 million worth of specific assets. That includes a 201 suite property in the Netherlands and a parcel of land in Toronto.
And where is that roughly $170 million going?
Yeah,
Because they clearly aren't using it to buy new apartment buildings in Vancouver or Toronto in this interest rate environment.
No, they're funneling this cash directly into buying themselves. Yeah, they are executing a normal course issuer bid, or NCIB. In Q2 alone, they bought back 0.9 million of their own units for $30.5 million at an average price of $35.59. Year to date, they've repurchased around $71 million worth of units.
Okay, here is where it gets really interesting and maybe a bit controversial for real estate purists.
Yeah.
I mean, is selling off perfectly good income-producing real estate in Europe and Toronto just to buy back your own stock actually a sustainable strategy?
It's a fair question.
Because when you sell a building, you lose the monthly rent it generates forever. Is management just trying to financially engineer a floor for the share price to keep investors from panicking?
I get why it looks like that. But to understand why they're doing this, we really need to dive into the mechanics of the valuation disconnect between the private market and the public market. We have to look at the net asset value, or NAV. The NAV is basically the accounting calculation of what the physical real estate is actually worth if you sold it today, minus the debt. CAPREIT's diluted NAV per unit sits at $54.38.
$54.38.
Exactly. Meanwhile, the public stock market is trading their shares around $33.88. That means the public market is pricing CAPREIT at a steep 37.7% discount to its actual appraised real estate value.
Wow.
So to answer your question about financial engineering, from management's perspective, buying your own premium real estate at a near 38% discount is arguably the most accretive allocation of capital available to them right now.
Let's take that a step further for the listener, just to visualize it. If they took that same $30 million and tried to buy a new apartment building in Toronto, they would pay the full private market price.
Right, top dollar.
But by executing the NCIB and buying their own stock, they're essentially buying prime Canadian real estate for roughly 62 cents on the dollar. I mean, when a company buys its own shares and retires them, it shrinks the total number of slices in the pie.
Exactly.
Even if the pie gets slightly smaller because they sold off a few buildings in Europe, the remaining shareholders' individual slice of the core Canadian portfolio just got significantly thicker.
That is the exact mathematical function they are relying on. It outperforms almost any new acquisition they could make in the open market.
But, if you're an income investor listening to this, hearing about shrinking the overall asset base while trying to maintain operations probably makes you wonder about the debt.
Oh, absolutely.
Because when you sell off assets to buy back stock, your leverage ratios can get stretched pretty quickly. What is the balance sheet risk here?
It is a legitimate headwind that definitely needs monitoring. Their total debt to gross book value is sitting at 41.2% as of Q2. That is up from 40.3% at the end of Q1 and up from 38.5% a year ago.
Yeah, over 41% leverage in a high-rate environment is, well, it's enough to make any real estate investor sweat.
For sure. Now, while management still describes this leverage as conservative for the multifamily sector, the trend is obviously moving in the wrong direction. But we have to remember the denominator effect here.
Right, the write-downs.
Exactly. The debt didn't necessarily explode in a reckless way. Rather, The gross book value, which is the denominator of that equation, shrank due to those $123.66 million in fair value write-downs we discussed earlier.
That makes sense.
Still, elevated leverage limits your operational flexibility. Management knows this, which is why they have explicitly stated that they are committed to making future share repurchases leverage neutral.
Meaning they aren't just going to blindly borrow on their variable credit facility to buy back stock. They will fund it purely through the opportunistic sales of non-core assets to keep that 41.2% jet ratio from spiraling any higher.
That is the stated discipline. They are matching the asset sales dollar for dollar with the stock repurchases to protect the balance sheet.
Okay, let's bring this all together for you, the retail investor listening. CAPREIT is fundamentally in a massive transition period right now. The physical operations are incredibly strong. I mean, they have high occupancy at 97.5%, and their profit margins on the properties are a very healthy 66.2%. But they are caught in this turnover trap where the people moving out are the ones who are paying the absolute peak rents from 2023.
Right, which is dragging top-line revenue growth down to a crawl.
Exactly. And management says it will take 18 to 20 months for this negative cycle to completely reset.
Right.
In the meantime, they are selling off European assets and non-core land and using the cash to buy back their own heavily discounted stock, all while managing a pretty tight 41.2% debt load.
That captures the cross-currents perfectly. And, while investors wait out this 18 to 20-month reset period, they're actually being paid to hold.
Oh, the dividend.
Yes. CAPREIT currently offers a roughly 4.4% dividend yield. And notably, it is distributed monthly, which remains highly appealing for income-focused retail portfolios.
A monthly dividend certainly softens the psychological blow of staring at a stagnant stock price that's hovering near its 52-week low.
It definitely provides a cushion. But this raises an important question, and it's a macro-level implication I want to leave everyone with regarding that massive NAV discount.
Okay, what's that?
We talked about how professional private appraisers calculate the real estate is mathematically worth $54 a unit, but the public stock market refuses to pay more than $34.
Right.
The public market might just be irrationally punishing interest rate-sensitive assets. But think about the broader implications for the Canadian housing crisis. If the largest corporate landlords in the country look at the math and decide it is fundamentally cheaper to buy back their own stock at 62 cents on the dollar than it is to build or buy new housing, who is actually going to fund the new residential supply Canada desperately needs?
Wow. That is a staggering implication for the broader economy. Make sure you follow the show for your daily earnings coverage. We'll see you tomorrow.